Okay, class, we're up to chapter 16, part 2b. Let me get rid of this, thank you. And we left off there. Now, a partnership is a fiduciary relationship, meaning that each partner owes to the other partner the duty of highest loyalty and must deal in good faith. There can be no conflicts of interest and things of that nature. Each partner has the right to access to the books. Generally, they have equal rights to manage unless they set forth something differently in the management agreement. However, there are some actions that require unanimous consent. Sometimes that's to take on a new partner or things of that nature. Each is entitled to a portion of the profits and is responsible for losses and liabilities. The partners are get their income from the sharing of the profits that are distributed by the partnership. However, a partner could also be an employee of the partnership and be paid a salary. Every partner has a right to inspect the books to make sure that everything is being done properly. The books have to be kept at the firm's principal business office unless agreed otherwise. And that right extends to a deceased partner's estate. Generally, each partner is an agent of the other partner, and general principles of agency law apply. As a consequence, a partner can subject the partnership to tort liability, as we talked about when we talked about agency law. So the acts of one partner can be liabilities for another partner, which is a problem with partnerships and why they have become less popular. So if you're going to do a partnership, you ought to have a lot of insurance. A better choice is to pick another form of business, particularly in states today that have what are called limited liability partnerships, which allow you to have a partnership form but also with limited liability. Each partner has the apparent authority to act on behalf of the partnership. And they have the implied powers to do so, to act reasonably necessary and customary to carry out the purposes of the business. So, partners are, of course, personally liable for the debts of the partnership. It's not just the partnership assets, it's the individual's bank account, house, car, and etc. That become potentially something that could be gotten by a creditor or anybody that the partnership owes a liability to. And that's what we call joint and several liability. So in joint liability, the third party sues all the partners as a group, but each partner can be held liable for the full amount. So if you have three partners and one partner decides to run and is now living in Ukraine, the other two partners are responsible for the debt, even though it falls unequally. Okay. Indemnification. So, with joint and several liability, a partner who commits a tort can be required to indemnify, that is, reimburse the partnership for any damages that the partnership pays. And a new partner is not personally liable for obligations occurred before that person became a partner. As we said, the taxation is flow-through. You pay individual tax on it. The information form is called a 1065 with the IRS. And you file a Schedule 1 K1 that then is converted onto 1040 on the front page as the amount that was transferred to you from the partnership. An interesting thing about partnerships is that the distribution of the income from the partnership to the individual partners may not actually be to the advantage of all partners at the same time. So for example, suppose that one of three partners also has a lot of other income outside of the partnership, and in 1 year that income is extremely high, putting them in the highest tax bracket. Then the money that they get from the partnership as their distribution is going to be lumped in with their other income, and they're going to pay a higher tax rate on it than they would perhaps in another tax year when they don't have as much of the other income. So when the partnership decides to distribute the income, can be very important for individuals. Okay, so that completes part 16B, and the magic word for chapter 16 is franchise.